Our market monitor guest tonight says there are 4 good reasons that stocks will keep going up. He's James Awad, chairman of Plimsoll Mark Capital. So, Jim, we're waiting for your top 4.
Okay. Well, the reasons that the market's going up, all of them remain in place, which are that the Fed is supplying this enormous liquidity, which is supportive of both the economy and the financial markets. Second, you have growing corporate profits. Third, you have sensible valuations on equities based on long-term valuations. And finally, in the type of environment that we're in, there is no powerful investment alternatives to stocks. Bonds provide low yields. Money markets provide almost nothing. Gold doesn't compete. Commodities are going down. And so you might as well own a share of growing profits with good dividends to get a total return in this type of environment. All those conditions remain in place.
Do you believe we're in the middle of a secular bull market, a long-term secular bull market, or in the early innings of one?
Well, we have been in one for some time, and the answer to that question, Tyler, depends on the news going forward. The risks that we have to watch are that there is tremendous speculation that has crept into the U.S. credit markets because of the Fed's easy money policy there, chasing people to take risks that may or may not end up being prudent. And I worry about junk bond yields. I worry about covenant-light loans. The same thing is going on in Europe, and they don't have growth, and we do. And also the geopolitical situation around the world, particularly in the Middle East, poses risk. And finally, while stocks are fairly valued, they're not as cheap as they were. So what I would say is that if none of the triggers are pulled, a credit event in the United States or Europe or a war, we will end up with stocks ultimately being overvalued, and that will be the end of the bull market. But that would give this market some more time to be labeled a true bull market.
All right, Jim, let's run through some of your stock picks that you think will do well in this environment. And at the top of your list is Johnson & Johnson. It's had a nice run so far this year. It's at $85 today. How much higher do you think it can go? Why do you like it?
Okay, so the theme here is you want to stay in because the situation for equities remains good, but there are risks, and you want to minimize your exposure to those risks. So a stock like Johnson & Johnson, which is world-class in terms of its balance sheet, in terms of its market share, in terms of its dominance in the markets that it participates in part of the need of its customers to buy its products, and yet it sells at only 15 times earnings and has a 3% dividend. So if the market itself goes from 15 times to 20 times, which could happen. That would be the point at which stocks are overvalued. This could go to 20 times, and you could have a $110 stock. And at the same time, you do have protection in case things get a little rough.
Let's take your next two stocks, Microsoft and Intel, that used to be joined at the hip in a good way. For much of the past decade and a half, they've kind of been joined at the hip in a bad way. Why do you like them now?
Well, that's what gives you the opportunity, that both of them have missed the movement from the PC to the handheld, and they're both aggressively trying to remedy that. And they do have the market share and the balance sheets to remedy it. And in the case of Microsoft, you're selling it basically 10, 11 times earnings. And in the case of Intel, just a touch higher than that. And they could both go to 13 or 14 times earnings. And in Microsoft, you have a yield a little less than 3%. In the case of Intel, you have a yield a little less than 4%. So if the multiples go up 2 or 3 points and you collect the dividend, you get a good return on the stocks.
Jim, thanks so much. Have a great weekend.
Pleasure.
Jim Awad, chairman of Plimsoll Mark Capital.